Most people walk into a bank with a stack of cash and think the only question worth asking is whether the teller will count it correctly. They are not thinking about federal reports. They are not thinking about compliance software. They are not thinking about a file being generated in their name and transmitted to the United States government. But depending on how much cash they are depositing, that is exactly what is happening. Automatically, before they even get back to their car. And the rules around this are more complicated than almost anyone realizes. Because the number most people have heard of, $10,000, is only the beginning of the story. There is a second rule most people have never heard of. There is a crime that most people do not know exists. And there is a federal law that has not been updated since 1970 that is right now the subject of the most significant proposed reform in over 50 years. If you keep cash, deposit cash, run a business that handles cash, or simply want to understand how your own bank operates, this is information you cannot afford to get wrong. The law that has not changed since 1970. The Bank Secrecy Act was signed into law in 1970. At its core, it established a simple obligation for financial institutions: report large cash transactions to the federal government. The specific tool created to fulfill that obligation is called a Currency Transaction Report, or CTR. Under the Bank Secrecy Act as it stands today in 2026, any cash transaction exceeding $10,000 in a single business day triggers an automatic, mandatory CTR filing by your bank. The bank does not have a choice. It is not a discretionary decision. It is a legal obligation, and failing to file carries serious consequences for the institution. That $10,000 threshold was set in 1970, and it has never been adjusted for inflation. Not once in over 50 years. When you adjust that number for inflation to reflect what $10,000 could actually buy in 1970 compared to today, the equivalent threshold in 2026 would be approximately $80,000. That means the law as currently written requires banks to report transactions that are, in real purchasing power terms, a fraction of what the original lawmakers intended to capture. The result is staggering. In 2023 alone, over 28 million currency transaction reports were filed across the United States. Financial institutions collectively spend approximately $59 billion annually, complying with Bank Secrecy Act requirements. Despite that enormous investment, when investigators examined how often these reports actually initiated criminal investigations, the numbers were sobering. In fiscal year 2023, IRS criminal investigation had approximately 2,676 criminal investigations. Of those, only about 9% originated from Bank Secrecy Act reports. In other words, the system generating over 20 million reports per year was the starting point for roughly 372 investigations. Most of those millions of reports, filed by banks on ordinary Americans and ordinary businesses, were never accessed by law enforcement at all. What happens when you deposit over $10,000, when you hand a bank teller more than $10,000 in physical currency? A specific sequence of events begins immediately. The teller triggers a currency transaction report. In 2026, most of this process is automated. You will not necessarily see a separate form being filled out. The bank's ACE's compliance software handles it in the background without interrupting the transaction. What the bank collects is your full name, your social security number, a valid government-issued ID, and in some cases, the stated source of the funds. That information, along with the details of your transaction, is transmitted to the Financial Crimes Enforcement Network, which is the Bureau of the United States Department of the Treasury, that administers the program and maintains the database. An important distinction that many people get wrong is what exactly triggers a CTR. Personal checks and wire transfers over $10,000 generally do not trigger a currency transaction report, because those transactions already carry a digital paper trail by their nature. The CTR requirement is specifically targeting physical currency, meaning paper bills and coins, cash deposits, cash withdrawals, currency exchanges, cash loan payments. All of these count. The type of transaction does not matter as long as it involves physical currency exceeding this threshold. What also matters, and what most people do not know, is how the $10,000 threshold is calculated. It does not apply only to single large transactions made at one moment. The rule applies cumulatively across an entire business day. All the individual cash transactions a financial institution has knowledge of being conducted by or on behalf of the same person during a single business day must be aggregated. Debits are added to debits, and credits are added to credits. If the total of your cash deposits in a single day exceeds $10,000, a CTR is required even if each individual deposit was well below that number. If you deposit $6,000 in the morning and $5,000 in the afternoon at different branches of the same bank, the bank is required to file a currency transaction report, even though neither transaction by itself crossed the threshold. This is the part that surprises most people. They hear the $10,000 rule and they picture a single large deposit being flagged. What they do not picture is multiple smaller deposits throughout the day, adding up to a reportable total, without any single moment crossing a visible line. The system is designed precisely to capture that pattern. The crime you did not know you could commit here is where the knowledge gap becomes genuinely dangerous. Once people hear about the $10,000 reporting threshold, many of them draw an obvious conclusion. They decide they will simply stay under the limit. They will deposit $9,000 or $8,000. They will break up their cash into multiple amounts below $10,000 and nothing will get reported. This reasoning feels logical. It is also a federal felony. The practice of deliberately breaking up cash deposits into amounts below the $10,000 threshold specifically to avoid triggering a currency transaction report is a crime called structuring. Its legal name comes from Federal Statute 31 United States Code Section 5324, and the definition covers any person who, for the purpose of evading reporting requirements, causes or attempts to cause a financial institution to fail to file a required report. The critical word in that definition is purpose. Intent is the element that distinguishes a normal deposit pattern from a criminal act. What makes structuring particularly dangerous is the specific thing it does not require. It does not require that your money came from an illegal source. It does not require that you were engaged in any other crime. It does not require that you evaded taxes, laundered money, moved funds for criminals, or did anything else wrong at all. You can be charged with and convicted of structuring even when every single dollar you deposited was completely legally earned. The crime is not the source of the money. The crime is the pattern of deposits combined with the intent to avoid reporting requirements. The penalties under this statute are severe. A structuring violation involving less than $100,000 in a 12-month period is classified as a Class E federal felony, punishable by up to 5 years in federal prison, up to 1 year of supervised release following prison, up to 5 years of probation, and a fine of up to $250,000. If the structured amount exceeds $100,000 in a 12-month period, or if the structuring is connected to another criminal offense, those penalties double. The maximum prison sentence rises to 10 years. The maximum fine rises to $500,000. On top of the criminal penalties, the government has the authority to seize and forfeit the funds involved in the structuring, regardless of whether those funds came from a legal source. The 91% problem. This is the statistic that fundamentally changed the public conversation around structuring enforcement, and it comes directly from a government audit conducted by the Treasury Inspector General for Tax Administration. In a review of 278 IRS forfeiture cases, where structuring was the primary basis for the seizure, the Treasury Inspector General found that 91% of those cases, meaning 252 out of 278, involved businesses and individuals whose funds were obtained completely legally. There was no evidence in those cases that the money came from an illegal source or involved any other illegal activity. The people caught up in those cases were not drug traffickers. They were not money launderers. They were not criminal enterprises of any kind. They were jewelry store owners, restaurant owners, gas station operators, scrap metal dealers, farmers, small business owners across dozens of industries who handled cash regularly and made deposits in patterns that looked suspicious to automated systems but had entirely innocent explanations. One documented case involved a Michigan grocery store owner who was only insured for cash, losses up to $10,000, and therefore routinely deposited cash in amounts near but below the reporting threshold to protect himself against uncovered losses. That insurance-driven banking behavior resulted in the federal government seizing over $35,000 from his account. A Maryland dairy farmer had $63,000 seized. He was not a criminal. He managed his cash the way his business required, and the pattern of those deposits matched the profile of a structuring offense. The Treasury Inspector General's audit concluded that the IRS's enforcement of structuring laws in those cases compromised the rights of individuals and businesses. The report found that IRS investigators often ignored entirely reasonable explanations provided by business owners for the deposit patterns. The audit found that the overall purpose of the civil forfeiture program was supposed to be interdicting criminal enterprises. Most of the people actually caught up in the enforcement were not criminal enterprises by any measure. This does not mean structuring enforcement has stopped. IRS criminal investigation reported 2,043 case referrals for prosecution in fiscal year 2025, with an 89% conviction rate. Structuring cases remain actively investigated and prosecuted. But the documented history of enforcement makes one thing undeniably clear. The definition of structuring is broad enough, and the intent element difficult enough to defend against, that ordinary people making ordinary banking decisions with completely legitimate money have found themselves facing federal felony charges, asset seizure, and in some cases years of legal proceedings before any funds were returned. The suspicious activity report, the rule below the rule beyond the currency transaction report threshold, there is a second, lesser-known reporting mechanism that operates at an entirely different level. It is called a suspicious activity report, or SAR, and understanding how it works is essential to understanding the full picture of cash transaction monitoring in 2026. A suspicious activity report is not triggered automatically by crossing a specific dollar threshold in the same way a CTR is. Instead, a SAR is filed when a financial institution knows, suspects, or has reason to suspect that a transaction or pattern of transactions involves suspicious activity related to possible violations of law. For banks and most financial institutions, the minimum dollar threshold for filing a SAR is $5,000. For money service businesses, the threshold is $2,000. But unlike the CTR, where any cash deposit over $10,000 triggers an automatic filing, a SAR requires a judgment call by the institution. The mere fact that a transaction is at or near the $10,000 CTR threshold is not, by itself, sufficient grounds to require a SAR filing, according to guidance issued in October 2025 by the Financial Crimes Enforcement Network, jointly with the Federal Reserve, the FDIC, the National Credit Union Administration, and the Office of the Comptroller of the Currency. A SAR is required only when the institution actually knows, suspects, or has reason to suspect that the activity is designed to evade reporting requirements or otherwise involves suspicious conduct. There is one important exception built directly into the structuring statute. A transaction or series of transactions does not need to exceed the $10,000 threshold at any single financial institution on any single day in order to constitute structuring within the legal meaning of the term. Structuring can occur across multiple banks over multiple days, and when banks detect patterns suggesting someone may be dividing transactions across institutions to stay below reporting thresholds, that is precisely the kind of pattern that triggers a suspicious activity report. You will never receive a notification that a SAR has been filed on your account. Unlike a CTR, which is simply part of the administrative process of a large cash transaction, a SAR is a confidential law enforcement tool. Banks are legally prohibited from informing customers that a SAR has been filed. The report goes directly to FinCEN, where it enters a database that federal, state, and local law enforcement agencies can access as part of investigations. The proposed change that could reshape everything. In October 2025, United States Senators Tim Scott of South Carolina, the chairman of the Senate Banking Committee, and John Kennedy of Louisiana, along with 7 additional Republican co-sponsors, introduced legislation known as the Streamline Act. The full title is the Streamlining Transaction Reporting and Ensuring Anti-Money Laundering Improvements for a New Era Act. The bill's central proposal is to raise the currency transaction report threshold from $10,000 to $30,000. It would simultaneously raise the suspicious activity report threshold for banks from $5,000 to $10,000 and the SAR threshold for money service businesses from $2,000 to $3,000. The bill would also require the Treasury Department to adjust both CTR and SAR thresholds every 5 years to account for inflation, meaning the amounts would no longer remain frozen as they have for the past 50 years. The argument behind the Streamline Act centers on the economic reality the original $10,000 threshold now represents. When adjusted for inflation, that 1970 limit is equivalent to roughly $80,000 in 2026 purchasing power. What that means in practice is that the current reporting system captures an enormous volume of completely routine transactions that lawmakers in 1970 never intended to flag. A government accountability analysis suggested that if the threshold were adjusted for inflation alone, the number of CTRs filed annually would drop by at least 90%. Bank industry groups estimated that raising the CTR threshold to $30,000 could eliminate somewhere between 75 and 94% of current filings at individual institutions. As of mid-2026, the Streamline Act has not been enacted into law. The $10,000 CTR threshold remains in effect. No change to the reporting threshold has taken effect. This bill is a proposal currently moving through the legislative process, not a law. Anyone managing cash deposits must operate under the current rules, which means the $10,000 threshold remains the legal trigger for automatic currency transaction report filing. The 7 behaviors that draw attention beyond the hard $10,000 CTR threshold. Banks operate automated monitoring systems that continuously analyze account behavior for patterns that may warrant a suspicious activity report. Understanding these patterns is not about teaching anyone to evade the system. It is about understanding how perfectly ordinary life situations can make an account visible in ways the account holder never anticipated. The first pattern that draws attention is sudden account activity that breaks a customer's established historical baseline. A person who has consistently deposited a few $100s a week and suddenly begins depositing several thousand has created a deviation that automated systems flag, regardless of whether the amount itself crosses any reporting threshold. The second is multiple transactions spaced closely together in unusual amounts. Several deposits or transfers in a short window, each in a size the account has not historically used, can look very different to a compliance algorithm than it looks to a human being with context about the customer's situation. The third is first-time wire activity on older accounts that have historically never used wire transfers. Wire transfers are treated as a high-attention transaction type under any circumstances. Using one for the first time on an account with years of non-wire history creates a meaningful signal in the system. The fourth is frequent movement between newly linked external accounts. If a customer recently connected their bank account to an account at another institution and then immediately begins moving money between them regularly, that pattern draws attention very quickly, particularly in the early weeks of that new connection. The fifth is cash activity that appears inconsistent with reported income patterns. Financial institutions and regulators increasingly cross-reference transaction activity against income levels and account history. Cash deposits or withdrawals that appear disproportionate to estimated income can trigger additional review even when the individual amounts are well below any reporting threshold. The sixth involves transactions connected to merchant categories, geographic regions, or industries that compliance software treats as elevated risk. The specific list of which categories carry automatic additional scrutiny is not published for customers, but certain types of transactions, regardless of a customer's personal context and regardless of the amounts involved, carry built-in flags that can initiate review. The seventh, what compliance professionals describe as panic movement behavior. Rapid withdrawals across a short period, large balance changes concentrated in a narrow window of time, inconsistent transfers that do not match any established pattern. The automated systems read instability itself as a possible indicator. The faster and less structured account movements look to the algorithm, the more they can resemble the behavior of someone attempting to move money quickly ahead of some adverse event. None of these 7 patterns requires criminal intent. Every single one of them can be produced by an entirely ordinary life event, a medical emergency, a real estate opportunity, an inheritance, a business decision, helping a family member in a crisis. The system does not know the difference between a customer responding to a legitimate emergency and a customer attempting to hide something. It responds to the pattern, not the explanation. And when it flags an account, that flag can follow the account forward through subsequent risk actions in ways the customer never sees and cannot easily address. Who actually gets flagged? The real-world pattern. The documented history of CTR and SAR. Enforcement reveals a consistent pattern in terms of who actually encounters problems under these rules in practice. It is not primarily sophisticated money launderers or organized criminal enterprises. Those actors have resources dedicated specifically to evading detection. The people who most commonly find themselves unexpectedly caught in the compliance machinery are small business owners who operate in cash-heavy industries, retirees making unusual financial decisions late in life, immigrants whose banking patterns reflect cultural norms about cash rather than criminal intent, and ordinary individuals who simply do not know the rules. A restaurant owner who deposits cash from weekend receipts in multiple transactions because that is how the cash comes in from the register has created a structuring adjacent pattern, even if the thought of evading a reporting requirement never crossed their mind. A retiree who decides to withdraw a significant sum to help a grandchild with a business purchase has deviated from their historical banking baseline in ways that automated systems notice immediately. An immigrant family that prefers cash-based transactions because that reflects how financial life worked in their country of origin creates a transaction history that looks unusual compared to the statistical models built from American banking norms. The Treasury Inspector General's documented finding that 91% of structuring seizures involved legally obtained funds from businesses and individuals is not a historical anomaly from a different era. It reflects something structural about how the Bank Secrecy Act's reporting requirements interact with the reality of how cash actually moves through the American economy. Most cash transactions in the United States are completely legitimate. The overwhelming volume of CTRs filed every year, over 20 million in 2023 alone, reflects that reality. Most of those reports are on people and businesses that did nothing wrong. What the IRS Criminal Investigation Division does with these reports, the Financial Crimes Enforcement Network maintains a central database of all CTR and SAR filings that federal law enforcement agencies access during investigations. The FBI, the Drug Enforcement Administration, IRS Criminal Investigation, Homeland Security Investigations, and dozens of state and local agencies can all query this database. CTR information is also shared with foreign financial intelligence units under bilateral agreements between governments, meaning a large cash deposit in the United States can potentially surface in an investigation being run in another country. In practice, the vast majority of CTRs filed are never accessed by law enforcement at all. A government accountability review of CTR usage between 2014 and 2023 found that law enforcement agencies accessed less than 3% of CTRs filed during that period through FinCEN's portal or agency's internal systems. The compliance machinery is generating tens of millions of reports. A small fraction of those reports are ever examined by a human investigator. The rest sit in a database as a searchable record that could theoretically be pulled in any future investigation that touches the account holder. What this means practically is that a CTR being filed on your account is not itself a signal that you are under investigation or that anything is wrong. It is an administrative record. The filing happens automatically, without judgment, as a legal requirement. Most of the people who had CTRs filed on them in 2023 never knew it happened and were never contacted by any law enforcement agency about it. The report exists in a federal database, attached to their name and social security number, available to investigators if a future inquiry ever pointed in their direction. Exempt persons and how the system accounts for legitimate high-volume cash businesses. 1. Aspect of the CTR system that many people who run cash-heavy businesses do not know about is the exemption process. Banks have the ability to designate certain customers as exempt from CTR filing under specific circumstances. These are called exempt person designations, and they exist precisely because some legitimate businesses handle cash in volumes that would otherwise generate CTR filings on a daily or weekly basis, without providing any useful information to law enforcement. Eligible exempt persons include certain Phase 2 businesses, which are non-listed, businesses that have maintained a transaction account at the institution for at least 12 months, have frequently engaged in transactions in currency over $10,000, and are incorporated or organized in the United States and regularly operate. When a bank files an exemption designation for such a customer, it no longer needs to file CTRs on that customer's routine cash transactions. The exemption is not permanent and must be renewed periodically, but it represents a meaningful accommodation for businesses that legitimately operate with large regular cash flows. The existence of the exemption system also underscores something important about how the CTR regime is designed to work in theory. It is not supposed to generate millions of reports on people and businesses with entirely legitimate cash operations. Exemptions exist so that the system can focus its attention on genuinely unusual cash activity. In practice, the combination of an unadjusted threshold, a massive economy, and incomplete use of available exemptions has produced exactly the situation the government. Accountability analysis identified. A system generating far more reports than law enforcement can meaningfully use, most of them on people who have done nothing wrong. What you should actually do. None of what has been described here should cause alarm for someone who handles cash in ways that are straightforward and transparent. The guidelines are actually simple once you understand them. If you are making a single cash deposit that exceeds $10,000, the bank will file a currency transaction report. That is a routine administrative process. It is not an investigation. You do not need to do anything differently. Provide the information the bank requests, which will include your identification and likely the source of the funds, and understand that the filing is simply part of how the system works for large cash transactions. There is no legal problem with depositing more than $10,000 in cash. The law requires the report. It does not restrict the deposit. If you have cash that you are depositing in multiple amounts over time, make sure those amounts reflect your actual banking needs and not a deliberate effort to stay below the reporting threshold. If your business generates cash receipts in amounts that naturally fall below $10,000, deposit them as they come in, without any adjustment to the timing or amounts. The pattern that creates legal risk is the pattern of intentional manipulation, not the pattern of ordinary commerce. A restaurant that deposits cash after each weekend's business in amounts that fluctuate between $4,000 and $8,000, depending on how busy the weekend was, is not structuring. A person who receives $20,000 in cash and decides to deposit it in two separate transactions of $9,900 each on consecutive days specifically to avoid a CTR filing has committed a federal felony. If you run a cash-heavy business and regularly handle transaction volumes that exceed $10,000, speak with your bank about the exempt person designation process. Your bank may be able to file an exemption that removes the routine CTR burden from your account, while preserving the system's ability to flag genuinely unusual activity. Keep clear records of the source and purpose of large cash transactions, not because you are required to justify every deposit you make, but because clear documentation protects you if questions ever arise. A business that can show its cash deposits correspond to sales records, point-of-sale data, or an other traceable business activity is in an entirely different position than one that cannot explain its banking pattern. Documentation is not an admission of suspicion. It is the most practical protection available for anyone who regularly handles significant amounts of physical currency. The proposed change and what it would mean if the Streamline Act were to become law, the landscape would change significantly. Raising the CTR threshold from $10,000 to $30,000 would eliminate the vast majority of current CTR filings at most institutions. Banks estimated that such a change could reduce their filings by 75 to 94%. The government accountability analysis suggested that an inflation-adjusted threshold alone would reduce filings by at least 90%. Under the proposal, law enforcement would receive far fewer reports, but those reports would represent a more concentrated set of transactions that more clearly exceed what routine commerce requires, which advocates argue would make the remaining reports more useful rather than less. The SAR threshold increase from $5,000 to $10,000 for banks would reduce the number of suspicious activity reports as well, with a similar goal of concentrating attention on genuinely concerning patterns rather than generating noise from routine activity that happens to exceed an outdated limit. But as of today, in mid-2026, none of this has happened. The Streamline Act is a bill introduced in the Senate in October 2025. It has strong support from banking industry groups, credit union associations, and some law enforcement organizations who believe the current system wastes compliance resources on low-value filings. It has not been passed by both chambers of Congress and signed into law. Until it is, or until some other legislative change is enacted, the $10,000 CTR threshold remains the law of the land. Every cash transaction exceeding $10,000 in a single business day, and every set of transactions by the same person in the same business day that aggregate above that threshold, triggers an automatic mandatory currency transaction report. The bottom line: there is one number in American banking law that every person who handles significant cash needs to know, and it has been the same number since Richard Nixon was president: $10,000. Above that threshold in a single business day, your bank files a report with the federal government automatically. Below that threshold, if you are deliberately managing your deposits to stay under it, you are committing a federal felony. The system does not require that your money be illegal for that crime to apply. It requires only that you intended to avoid the reporting requirement. 20 million currency transaction reports were filed in 2023. The overwhelming majority of the people those reports were filed on had done nothing wrong, and they will never hear anything about it. But the documented history of enforcement, including the Treasury Inspector General's finding that 91% of structuring seizures in a government sample involved legally obtained money, is a clear record that innocent people with innocent money can and do end up in serious legal trouble when they misunderstand these rules or decide to work around them, without understanding what working around them means under federal law. The rules are actually simple to follow. Deposit your cash honestly, in the amounts and at the times your actual financial situation requires. Understand that deposits over $10,000 will be reported, accept that as part of the legal framework for large cash transactions in the United States, and provide the requested information transparently. Do not split deposits to avoid reporting. Do not make decisions about deposit timing or amounts based on the reporting threshold. Keep clear records of where your cash comes from and what it is for. The number is $10,000. The law is 56 years old and has never been adjusted for inflation. A Senate bill that would raise it to $30,000 has broad industry support, but has not become law. And the consequences of not understanding exactly how this system works and deciding to work around it instead of through it remain serious federal felony charges, asset seizure, and in documented cases, years of legal proceedings over money that was never dirty to begin with. Understanding the system is not complicated. Operating within it honestly is even simpler. The only genuinely dangerous thing is believing you understand the rules when you understand only part of them.